Hello, I'm Jess Bozzo of Performative, an Argyle company, the leading online resource for the Office of the CFO. I would like to welcome everyone to today's webinar, Demystifying SaaS Finance and Accounting. I would like to thank our sponsor, ChargeBee. ChargeBee is a recurring billing and subscription management tool. ChargeBee is the right tool for subscription businesses of all sizes across industries, whether you're a startup or an enterprise with complex needs. Their commitment to thought leadership helps us make today's webinar possible and delivered at no cost to the participants. Before I introduce today's featured speakers, we have a few housekeeping items to cover. The slides are available under the resource list. We will send you links via email to the presentation and the recording within 24 hours. For those seeking CPE credit today, you must answer all polling questions and remain on the line for the duration of the webinar. Credits are awarded in 24 hours. To retrieve your certificates, you'll need to sign in on the Performative website to view your profile. You can then select My Account, My CPE to view your certificates if you're eligible. If you have any questions on credits, please email cpe@performative.com. Please submit any and all questions that come up during today's webinar into the Q&A section of the interface. We've set aside some time following today's presentation to address your questions. And finally, please take the short survey at the end of the webinar. Now it is my distinct pleasure to welcome today's featured speakers from ChargeBee. On the line today, we're excited to have Karthik Srinivasan, Director of Finance. With over 13 years of experience leading and managing finance teams in the information technology and the SaaS domain, Karthik has seen the evolution of SaaS finance and the nuances behind it. Karthik is responsible for financial planning and accounting, adherence to compliance, and efficient financial operations at ChargeBee. Also on the line today, we're excited to have Prasanth Kathari, Product Manager, also with ChargeBee. Prasanth is passionate about building products that customers love, currently trying to solve fintech challenges in the subscription billing world. He has worked on building best-in-class integrations with Xero and QuickBooks Online, and is now testing mid-market and enterprise integrations with NetSuite and Sage Intacct. I'll now turn things over to Prasanth to start us off. Welcome, Prasanth. Over to you.
Thank you, Jessica. So a warm welcome to all our audience members today who have joined from across the world. In this webinar today, we'll be discussing the role of finance and accounting in the SaaS world, in the software as a subscription model world. How the metrics change and what does it mean for the CFOs and the finance team? How revenue recognition, has evolved in this business model transformation from on-premise to the SaaS business model. And the need for revenue automation and streamlining the operations is something which we'll be discussing in today's webinar. So thank you for joining. Here's a quick statistics before we begin. So as per Gartner, all the new entrants and the existing vendors, approximately 80% of our vendors will be offering subscription-based business models by 2020. So this provides a major shift in how businesses operate. So before we begin, we have a quick poll. Jessica, over to you for the polling question.
Excellent. Thank you so much. As mentioned, this is our first polling question of the day. This one says, does your organization have plans to shift to a subscription-based business model? The answer options for this question are yes, within the next year, yes, within the next 2 years, no, I don't know, or we already have subscription offerings. Please take a few moments to select your answer. As a reminder for those attendees seeking credit for today, you'll need to answer all 3 polling questions. Again, this is our first one. I'll leave this question up for a few more seconds to allow everyone to respond. And once we close this question down, we'll share the results and have our speakers make a few comments before moving on. So please go ahead and make your final selection here. And what we'll do now is go ahead and display the results. Here they are. I'll turn things back over to our speakers so they can comment before moving on.
Yes, sure. So these results seem to be, great to look at and ponder upon. Around 35% of our audience are mentioning that they are yet to shift to a subscription-based business model, and the challenges which they will face is something which we can discuss in this webinar. And it's also nice to see that 25% of our audience members have voted for currently working on the subscription offerings. So thank you for sharing your results. Here are some other quick stats on how the evolution is happening. So there's a significant shift today from using the license model of software to using a hosted software or software as a service, as we can see on our screen right now. And the line items in the traditional on-premise model are different as opposed to the hosted services. The typical invoice would look like an initial license fee, the implementation fees, a customization fee, an annual maintenance or a support fee. In the subscription model, all these are bundled into a subscription fee or a setup fee over the subscription fees. With the shift to SaaS model, the success of the business does not depend anymore on how many units of software are sold, but on how many customers are willing to use your product on a recurring basis. So what is your take on this, Karthik? How is accounting different for SaaS businesses?
Thanks, Prashant. Yeah, I think as you rightly mentioned, there is a fundamental shift in terms of how SaaS companies are looking at this model. I mean, as compared to a traditional license model, what you're obviously seeing is that the unit of measurement is no longer in terms of number of products or number of licenses sold, but is more in terms of number of customers or subscriptions. And that's definitely a significant shift that's happening. The other thing that you witness as part of this shift is the fact that SaaS model is all about scalability and traction, like a license model, where the revenues are not gently recurring. Also, since pricing is based on usage related to consumption, customers coming in and moving out is fairly easy and straightforward, which is why things like customer retention and renewal becomes relevant to measure and understand. So that's on the fundamental shift in terms of what's happening. The other aspects in terms of what is different in a subscription model is the cash flow dynamics, because obviously, the ticket size is much lesser as compared to what it is in a traditional license model. You have more number of transactions happening. And if you have more number of transactions happening, obviously, the number of payments that will come through and get recorded is also that much more, which will have to be taken care by the finance team. Right. The third aspect to this change that we're witnessing is the fact that in a traditional license model, generally manpower is more intensive as compared to a SaaS model, where it's all about higher S&M or selling and marketing expenses. The COGS, or the cost of goods sold, is generally much lower because it's primarily to do with hosting and customer support services. So you'll definitely see variance in terms of how gross margins are computed for a SaaS model. Typically in a SaaS model, gross margins are pretty high. S&M, on the other hand, is also high, which means your net margins are much lower, as compared to a traditional license model where the gross margins are typically around the 50-60% range, whereas your net margins are far better. So that's one significant difference between how a SaaS model works compared to a traditional license model. The fact remains that metrics in a SaaS model is the real key element, and it has a key role to play as compared to financials, because obviously financials only talk about things that have happened now, whereas metrics is more futuristic and talks about things that are yet to come. So hence, the customer ROI becomes a key differentiating factor in a SaaS model over the product ROI in a traditional license model, where in a SaaS model, the value of the customer is realized with duration.
Thanks, Karthik. So this shift in financial aspects from capital-based to relationship-based might be challenging. What are the high-level challenges that a subscription model brings in for the CFOs?
Yeah. So if you look at the challenges from a CFO's perspective, it's all about, so broadly there are three categories where we have these challenges coming from. One is in the domain of managing subscriptions and billing, which is all about how do you manage one-time revenue vis-a-vis recurring revenues. Because in a SaaS model, you typically have both of these flavors coming in. One-time revenues could be things like setup fee, migration fee, whereas recurring revenue is more about what is it that hits your books month on month. And with the added complexity of overages also, coming and filling into the recurring revenue bucket, it makes things a little more difficult to absorb. The second aspect with regard to managing subscriptions and billings is also the fact which I kind of thrown light on already in terms of cash flow dynamics, where you need to have a seamless mechanism to collect payments and ensure that the dunning mechanism that you have in place is helpful and robust. The other aspect is the complex scenarios to do with upgrades, downgrades, pausing of subscriptions, cancellation of subscriptions. There are a whole lot of events that happen during the life cycle of a subscription. So you need a mechanism, or you need a finance team which can understand these dynamics and cater to requirements in terms of ensuring that the right numbers are captured at the right point of time, and calculations in relation to proration, etc., are handled carefully. The second bucket to do with revenue recognition, obviously, the nuances of a SaaS model obviously brings nuances with regard to revenue recognition as well. We're going to touch more about this when we talk about the implications of 606. But what is important or pertinent to note here is this is something that CFO should be aware of. Last but not least, the least is the reporting aspect of it, where you have a whole lot of things that you need to cater to specific to the SaaS business model. You have because the model itself is the pricing that typically prevails in a SaaS model is not only dependent in terms of how do you look at numbers, it's also dependent on how your customer or your merchant prices his product to his customers. So things like overages, where you factor as part of your metrics, is dependent a lot on how the end customer's business performs, right? So it's equally important to analyze these things, which is why the analysis that typically a SaaS company goes through is more robust. It's not just about understanding your customer's business, but it is also understanding the end customer, the customer's business as well. So, and also to do with things like spend analysis. As I told you, the S&M bucket is a very important bucket for SaaS companies. It's important to understand how the S&M or the sales and marketing cost contributes to your top line, and what is the payback period that it typically generates. So yes, there are unique challenges to the SaaS business model, which needs a robust system for billing and reporting to cater to. Fortunately, I'm in a position to consume ChargeBee's billing and reporting automation to support my needs. But the needs of a subscription business quickly outgrow your traditional systems, and your billing intelligence system begins to hold the key.
Okay, so if I understand this right, CFOs need to now adapt to the recurring revenue business models and upgrade on how they derive metrics, recognize revenue for different types of line items and subscription scenarios, and managing a system which automates the revenue operations. So can you elaborate how the metrics differ as part of this transformation?
Sure, Prashant. So one of the things that we talked about is how SaaS metrics, or metrics which is consumed essentially by the executive team, is different from financial metrics, right? SaaS metrics is all about giving you trends and tendencies of how things are going to work out for you in the future, as compared to financial metrics, which is more to do with things which are happening and which helps you measure things that have happened now, right? So if you want to deep dive into how SaaS metrics typically work, it's important to analyze them under two broad categories. And this is how I think it makes sense for most companies to see SaaS metrics. One category is called standalone metrics, which is typically your monthly recurring revenue, your annual recurring revenue, things that will help you measure and make sense of the performance of the business through one single metric or formula, right? It could be a churn, it could be the lifetime value of a customer. So these are typically standalone metrics which gives you a sense of a business and are able to stand by themselves and help you make sense, in terms of how the business is performing with regard to that metric. The other category to metrics is what we call relationship metrics. Now, these are the new age subscription metrics, which is more to do with trying to correlate and build a relationship between two standalone metrics, right? For example, if you have something like lifetime value of a customer, right? You try and relate it to the cost of acquiring a customer, just to understand what potential revenue that you generate, right, by spending X dollars, right, in terms of your sales and marketing, right? Similarly, you have a payback period, which is more to do with trying to understand how much of your cost of acquisition that you're spending today actually contributes to bringing revenue for you probably in the next month or in the next quarter. The third element, which is important from a relationship metric perspective, is the cohort, right? And this is something that you will find most SaaS companies using to make sense of how the business moves month on month. So, I'll give you an example of how cohorts typically work. Assuming that you're looking at say a month MRR coming in a particular month. Say for example the month of January. If you have an MRR of say $10,000 coming through, you want to understand how the customers coming in that particular month are moving across future months and how is their percentage actually improving. So that kind of representation is better made available through our cohort. It helps you measure things like net retention, gross retention, your net dollar expansion. So all of this is what relationship metrics is all about, right? Now, so between these two different categories that we have, one being standalone metrics and the other being relationship metrics, what's important for companies to do or to understand is to try and build a mechanism to standardize these metrics. Because unless and until you come into or you get into a mechanism where you standardize these metrics, it becomes difficult to compare and benchmark them. This is particularly relevant even for VCs when they look at metrics. It is easier if you have a standard set of metrics across the board, so that then you can give useful insights and make comparisons in terms of how different companies are performing. So for standardizing metrics, we typically recommend the 3 C's approach. This is something that we've tried to internalize here within ChargeBeat. The 3 C's is all about standardizing metrics using the principles of being consistent, comparable, and conservative. Right. Pretty self-explanatory, but just to give you a perspective, so if you're measuring CAC, for example, in a certain manner, so there are different companies which follow different approaches to how a cost of acquisition or CAC is measured. Right? There are companies which take the entire sales and marketing cost and call it as CAC or cost of acquiring a customer. But there are companies which probably take only 80% of their sales and marketing because they believe that the remaining 20% is towards running the operations of the sales and marketing function and is not really related to bringing customers on board. Right? So it's important that we decide in terms of which methodology we want to use, and it's important to use it consistently, because only when you use it consistently it becomes comparable. The third aspect is conservative. Now this borrows a lot from what generally accepted accounting principles, GAAP principles generally prescribe, where you want to use the principle of conservatism wherever possible. To give you a context or an example, so LTV, for example, lifetime value of a customer, there are different ways in which you calculate LTV. Typically, an LTV is calculated in terms of dollar value by taking your ARPU and then dividing it by the churn rate. Right. Now, question arises as to whether you want to factor the cost of goods sold as part of the ARPU, which means you basically reduce the gross margin, right, from your revenue and then calculate your lifetime value of a customer, or you calculate it based on the revenue itself. So there are two different methodologies that you can use. Now, using gross margin as a factor will probably give you a lesser number, but then what it does is that it keeps your numbers a little conservative, so that you don't get into the practice of overshooting your numbers and then hitting yourself on the wrong side. So this is all about how SaaS metrics kind of resonates and works differently as compared to financial metrics. But it's important that you have a strong mechanism internally to kind of have these metrics in place.
Thanks, Karthik. That was a deep insight on the metrics which are used for a SaaS business model. The next part is something which we want to ask you about was revenue recognition. So before we deep dive into revenue recognition, let's have a quick poll to understand the readiness of our audience members with respect to ASC 606 compliance. Over to you, Jessica.
Excellent. Thank you so much. This is our second polling question of the day. And again, this one says, how ready are you with respect to ASC 606 compliance? The answer options for this question are not sure, still figuring it out, work in progress, adequately prepared, or already compliant. We'll ask that you please take a few moments to select your answer. Another friendly reminder for those attendees seeking credit for today, you'll need to answer all 3 polling questions. Again, this is our second one. We'll leave this question up for a few more seconds to allow everyone to respond. And just like last time, once we close this question down, we'll share the results and have our speakers make a few comments before moving on. So please go ahead and make your final selection here. And what we'll do now is go ahead and display the results. Here they are. I'll turn things back over to our speakers for a few comments before moving on.
Thanks, Jessica. So interesting results here. There are a bunch of companies, I think, as part of the poll results, working on the ASC 606 related requirements, and equally the other set of members are still figuring out how to be compliant to ASC 606. So let's ask this question to Karthik. With regards to revenue recognition and ASC 606 compliance, what do you think the finance teams in SaaS companies should be aware of?
Yeah. So from a 606 perspective, Prashant, I think what's important to understand is, I think the standard is obviously, it's probably a old wine in new bottle kind of a thing, in the sense that a lot of it that 605 talks about is what 606 resonates, but just that it's much more organized in a manner that, companies or corporates can comply to and ensure that the revenue that they recognize is realistic and there's no question of understatement or overstatement that gets into the financial books. Now, in terms of the ASC 606 RevRec process, right? Obviously, I think all of us are aware of the 5-step process that the 606 standard pretty much requires. So I'm not going to deep dive too much into the 5-step process, because that's something that is like pretty much what everybody is aware of. But I just want to touch upon some nuances which is specific to SaaS companies from a 606 perspective, because that might be important for the audience to understand. So if you look at 606 from a subscription business perspective, I think first and foremost it's important to understand that a contract typically means a subscription, right? From a SaaS company's perspective. So if you're looking at a SaaS model, your subscription is what pretty much correlates to what a contract is in terms of identifying the contract. The second important piece is in terms of identifying performance obligations. Now, this could be pretty difficult for a SaaS company, given the fact that, as Prashant rightly indicated when we started off this conversation, that in a SaaS model, typically everything is bundled together. So you have your license fee, you have your implementation component, and then you have a support component, which is all bundled together and charged as one single subscription fee. So, which is why it becomes a little difficult to unbundle this and identify separate performance obligations, right? So that is going to be a very crucial aspect when we're looking at compliance from a 606 perspective. It is important for finance guys or the finance team as a whole to understand what obligations can stand on their own. If you feel that an implementation fee can stand on its own and it has a market value that it can fetch independent of the license to the subscription fee, then it probably makes sense to call it out as a separate performance obligation. Because this is the most important part in terms of how, the 606 compliance will be applicable to subscription businesses. It's important to crack this piece, with a lot of attention so that you get it right. The next aspect is obviously then, once you've identified the performance obligations, is to assign an SSP. Now, the challenge that subscription companies might typically have is, what do I actually call out as a standalone selling price? So what is the SSP or my standalone selling price is a question that subscription businesses might typically have. So one way to address this, or what we've seen from what the companies are doing, is to typically take your list price as your standalone selling price, because then that becomes easier for you to apply, given the fact that that's something that's readily available for people to see, given the fact that for most SaaS companies, pricing is pretty much listed on the website and most of the traffic is inbound. The third aspect is to do with the transition provisions. Obviously, when you're moving in or moving out from a 605 to a 606 perspective, it's important to understand the data between the revenue that was already recognized using 605 principles and what is now going to get recognized under 606, and recognize the delta when the compliance kicks off. The compliance obviously kicks off from December 15th of this year, but for private companies, but it will require you to probably do a comparative reporting for the previous period, which means you'll have to go back in time, recalculate your revenues from a 606 perspective, and then capture the delta between 605 and 606 as a separate line item from a disclosure perspective. So that's when the transition provisions become relevant. As regards to key considerations that one needs to keep in mind, besides the principal methodologies that needs to be followed, the aspect related to discounts and free trials is something which is unique to SaaS companies. So earlier, if a mechanism was being followed where, say, a discount of $200 for a $1,000 subscription was given in month one, and if the revenue for that particular month was taken as $800 under the earlier standard, what the 606 standard needs you to do is to defray the $200, assuming that you have a one-year contract. You defray the $200 over the 12 months and recognize the revenue ratably month on month, so that the discount that was given to you was given with an intent that you enter into a one-year contract. That's something that 606 needs you to recognize and take stock of. As regards free trial periods, this could be a little difficult for companies given the fact that this is not something that people are used to. So assuming that you have a free trial period for 3 months and you're starting a subscription from month 4, as per the earlier standard that prevailed, all that you had to do was start your revenue recognition only from month 4, given that the subscription or the payment typically, or the invoicing typically started only from month 4. But 606 looks at it a little differently. What it says is you need to amortize the revenue that you've taken from month 4, starting from month 1 itself, and also defray it over the free trial period. So these are some important considerations that one should consider. The one on setup fee, obviously, is which is also called as non-refundable upfront fee, will need considerations in terms of material right and non-material right. I'm not getting into the details of material right versus non-material right. We'll probably even take it offline. If any of you have any questions, feel free to write to us and then we can come back to you. But I just touch upon variable fee considerations because that's something that I'm sure most SaaS companies will get to experience. So the way variable fee consideration typically works under the 606 umbrella is that you use, given the fact that it's something that's invoiced at the end of the month, the principle of as invoiced practical expedient can probably come to a rescue, given the fact that variable fee typically correlates to the performance of the previous month and revenues are recognized based on when it's invoiced. So I think the as invoiced practical expedient would apply to most SaaS companies is what I believe, but there could be exceptions to that principle. So that's what I had to share from a 606 perspective in terms of the different considerations that's important from a SaaS perspective.
Interesting, Karthik. So that's a very extensive explanation on revenue recognition, the considerations in a subscription model, Karthik. Thank you. I guess so. Here there's a need or a dire need for an automated system, and it becomes more and more important as operations become need to be more streamlined. For instance, the automated generation of the report, as you mentioned, with variable elements like subscriptions changing during the period of its term, proration when a subscription is changed, discounts are applied, or trials are a free trial is provided. That leads me to the next question, Karthik. All the challenges we have been discussing from a finance perspective essentially then translate into the operational requirements or the operational overheads as well. with a huge volume of invoices or customers flowing in on a daily basis, there might be a huge dependency on operations. What are your thoughts on that? Like, what do you think the CFO should do from a revenue operations standpoint?
Absolutely, Prashad. I think this is definitely a challenge, given the fact that the volumes involved are very high, the ticket size is less, but the volumes coming through in terms of invoices and payments is like only keeps skyrocketing, assuming that growth keeps happening year on year. It is definitely something which becomes painful. Which is why, from a finance perspective, some of the capabilities that a finance team typically needs to handle a complex business model as that of SaaS is these three things that you're seeing, right, as part of the slide set that we have put up. One is to do with subscription management, which is all about how do you look at setting up complex pricing models. Because pricing models need not be straightforward. You could have a combination of invoice-based pricing. You have a combination of things related to number of users. So pricing models can be as simple as just having a base price, or as complex as having a combination of base price and overages tied to it. And then you have tiered-based pricing, volume-based pricing. You can keep adding it to that list. And then you also have this challenge of how do you take care of upgrades that happen during the tenure of the contract. How do you invoice the customer in between? How do you cancel the customer and the customer moves out? How do you ensure that a credit note is passed on to him? So there's a whole lot of things that moves around this cycle of invoice and billing management, which is something that becomes difficult to handle. Specific to capabilities from an invoicing standpoint, as I told you, you need an efficient system to customize invoices. You need the ability to generate credit notes. You need the ability to generate orders, have unbilled charges, have advanced invoicing being done, have a smarter collection dunning mechanism in place. Because imagine a situation where you created a subscription, but for some reason you don't want to bill the customer. Right? You should still be in a position to you should still be in a position to understand what are the charges that remain unbilled to that customer. So that becomes important for the finance team to understand. So how are you going to do it? Is something that finance teams need to think about and have an efficient process to ensure that this happens seamlessly. Right? You talked a lot about collections as well. I mean, that's again a pain point, right? With multiple transactions coming in or multiple payments coming in, how do you reconcile it with payment gateways? How do you ensure that what's there to be tracked manually is matching up with what you recorded in your accounting system? So all this becomes a lot to absorb from an invoicing standpoint. And last but not the least, reporting obviously is a challenge that, at the end of the day, if all of this is being done to get the numbers right in terms of ensuring that it reaches the right people at the right point of time. So when you talk about reporting, you need metrics which have to be generated at different levels. You need metrics for the executive team, which are things like MRR, what is my monthly recurring revenue, what is my annual recurring revenue, what is my annual contract value, what is my lifetime value of a customer, what is the cost of acquiring a customer, what is my churn rate. So these are typical executive level metrics. And we talked about standalone metrics and relationship metrics. And all of that fit into this ambit of executive metrics. And then you have functional metrics, which is interesting. Like, for example, you have metrics specific to the sales team. The sales team wants to understand what is the pipeline for a particular quarter. Or the marketing team wants to understand how many leads have got generated. Right? So, and sales and the marketing team then want to together look at what proportion or what percentage of leads have actually got converted to deals and how many of those deals have actually materialized in terms of the company winning those deals. So if you look at function level metrics, there again is a lot to absorb. You have support functions who might want to look at the number of tickets being generated, what's the average response time for tickets. So reporting can be or is expected to be pretty robust both at the executive level as well as the functional level. And from a reporting standpoint, integration with an accounting system, because at the end of the day, the books is what actually matters from an audit from an accounting standpoint. So it's important that all of the information that we have talked about in terms of invoicing and subscription management is all adequately captured in an accounting tool, whichever or whatever that we might be using, the QuickBooks or Xerox or NetSuite or Intacct, all of this needs the right numbers to get reflected so that the financial gap reporting happens the way it happens. So all in all, just to summarize, I think it's imperative that you have, so it needs a full-fledged end-to-end view if you've got to get it right, and that's what it looks like.
Thanks for summarizing that, Karthik. From my experience of working with the product and building out integrations, I've realized that managing a revenue operations process throughout requires a bunch of modules or capabilities which you mentioned. And if you look at the way customers are acquired, be it customers coming in signing up from your website, or customers who are the opportunities who are converted into contracts or deals, would then convert into subscriptions are created for these customers, and invoices are generated on a recurring basis. And the billing intelligence layer would have an integration with a bunch of payment gateways, so that the customers are able to make payments via online or direct debit payment methods. And once the invoices are generated, I think from a workflow perspective, the invoices would then sync with the accounting software which is in place, and then the finance teams would manage the reconciliation with the bank statement. The billing intelligence layer, something like ChargeBee would integrate with the accounting system and ensure that all the billing related details, including the invoices, the transactions, payments and refunds, the credit notes, the customers and product information are actually synced from the billing system to the accounting or the ERP system. And in addition to the experience of working with SaaS customers and in the billing layer, an automated billing system would generally help you with automating your recurring billing. Customers would be able to make payments via multiple payment methods: credit cards, PayPal, Apple Pay, direct debit, ACH or SEPA, depending on the geography you are operating in. Merchants will be able to create products and pricing, as Karthik had mentioned. Different pricing models like tiered, volume, SaaS-based pricing models could be supported. The merchants should be able to manage the subscription changes, as in if customers are upgrading or downgrading, say adding a few more users or seats as part of the workflow, would be a major set of capabilities. In addition to subscription management, merchants would require the ability to customize invoices based on the invoice compliance requirements, like what should be the details to be shown on the invoice, the shipping address, the customer's organization address, the tax registration number, etc. The branding stuff can be customized for the invoices. In addition to, I think merchants should be also able to configure when to actually invoice their customers, like 5th of every month, or which is calendar-based billing, or anniversary-based billing, as in whenever the customers are actually signing up, then go ahead and invoice the customers. And based on that, I think also prorate the charges for your customers. For example, if someone is signing up on 27th, but if your merchants are billing every 5th of every month, then there would be a small delta in the billing period, and how should the billing system prorate or not for that period. Also, the ability to consolidate invoices if there are multiple subscriptions for a customer, or if multiple subscriptions have been purchased from the same organization. And in addition to that, payments are being collected online, so there's a chance of payments failing. So the billing layer would be having smart dunning or collections module, which is able to retry payments and remind the end customers to update the payments in case the payments have failed. And I also think the integrations play a key role where, as part of the revenue operations workflow, the merchants would like to manage the lead to cash workflow in a streamlined manner. So the billing system interacts with a sales automation system like Salesforce, sync all the opportunity and subscription data from a Salesforce or a CPQ system like Apttus CPQ. Then Taxation happens with the help of Avalara or tax jar kind of systems where the taxes are calculated based on the products or the zip codes. In addition to that, once the invoices are generated, finance teams, I think, would require an integration with an ERP or an accounting system. Generally, the trend which we have seen is that SMB companies would prefer a system like Xero or QuickBooks compared to mid-market or enterprise customers who prefer Oracle, NetSuite, or Sage Intacct. So I think from an operations perspective, the integrations also help in streamlining the workflow. And a revenue analytics platform like to derive the metrics which Karthik just mentioned, like the monthly recurring revenue, the lifetime value, the customer acquisition charges, costs, etc., can be streamlined if there's a revenue analytics platform. For example, we have SaaS's revenue story, which is able to crunch numbers on an on-demand basis and is able to provide the reports for our merchants. So I think that brings us to the end of the webinar and a quick insight on how finance teams are able to or should be stepping up for the challenges which the SaaS model brings compared to the traditional one-time or on-premise business model. We would like to have another poll to end this webinar. Over to you, Jessica.
Excellent. Thank you so much for a great presentation. Really appreciate you guys sharing all of your insights and expertise with us today. As mentioned, before we head into audience Q&A, what we'll do now is go ahead and launch our third and final polling question. This one says, which of the following accounting software do you use? The answer options for this question are SAP, Oracle NetSuite, Sage Intacct, Microsoft Dynamics, QuickBooks, Xero, or others. As a reminder, you must answer all polling questions to receive credit for today's webinar. This is our final one. We'll leave this question up for just a few more seconds to allow everyone to respond. And again, once we close this polling question down, we'll share the results and have our speakers make a few comments before moving to audience Q&A. So please do remember to submit your questions for today's speakers. All right, let's go ahead and take a look at the results here. What we'll do now is display those results. Prashanth and Karthik, over to you for a few comments before we head to Q&A.
Oh, yes, sure. Again, another interesting set of results for us to consume here. We see that the majority of our audience are using QuickBooks, and I'm assuming it's either QuickBooks Online or QuickBooks Desktop editions. And in addition to that, the closest next is Oracle NetSuite. So that's again a good find here. Thanks to the audience members for sharing the details.
Excellent. Well, without further ado, let's go ahead and move to audience Q&A here. We'll now review some of the questions that have already been submitted by the attendees, and a friendly reminder that you can still chat in your questions, and we'll pose those out now. One of the first questions that we had come in says, what is the difference between licenses and subscriptions? It sounds the same to me.
Yeah, sure. So I'll read out the question just for ease of the discussion. What is the difference between licenses and subscriptions? As part of our initial, as part of the initial discussion, we wanted to differentiate between a subscription-based model versus the one-time, all the capital being paid on a one-time basis, right? So the traditional model required merchants to pay the server fees, the setup fees, the installation fees, the customization fees in order to set up your product. So that would be a one-time basis, and versus the subscription model where you only subscribe to a specific module of the software, and the software is hosted, so you don't bear a lot of fees on your side. So that was the intent for bringing up the traditional model versus the subscription-based model. I hope I have answered that question.
Yeah. Just to add what, Just to add what Prashanth said, like you rightly mentioned, one important difference between the two models is in a traditional software model, what typically happens is the investment in terms of hardware and the related components is something that the company backs in terms of putting the software in place. But in a hosted model, what typically happens is the company which is providing the service, right, has the infrastructure in place, and you use the software on a pay-as-you-go model. So that kind of pretty much supplements what Prashant said. So I hope we hope that it clarifies. Okay.
Excellent. So, no, that's great. Thank you so much for clarifying there, Prashant and Karthik. Another question that we had come in was in reference to one of your slides in particular. We think it was slide number 17. So maybe what we can do is just pull that back up so you guys could take a look at it there. This attendee writes, can you explain what the percentages mean or how they are calculated?
Right. So in a cohort, what typically happens is the base month, right, is typically 100%. That becomes the base month, right? And say, for example, let's take an example. Supposing you have an MRR of say $10,000, right? So $10,000 becomes is the number say in month one. So that becomes 100%, which is the base. And supposing the $10,000 is say $15,000 in month two, it expands to $15,000 in month two because of expansion happening in terms of the MRR that is coming through, or for new customers that are coming in in that particular month. So what essentially happens is the movement between $10,000 to $15,000 is typically captured as an expansion percentage, right? So a customer who's coming in month one at $10,000, when he moves to $15,000 in month two, the percentage increase, right, which is 50%, right, is basically added on to the 100%, and you typically see 150% coming in month two, which is to basically connote the fact that this particular list of customers who come in month one have actually expanded by 150% as compared to month one. So that's how a cohort is typically, right? And you keep doing that month on month to understand how your expansion works. So it's all about taking a base month, trying to understand the base month basically becomes your 100 percentile, and then you try and relate it to each month in terms of how it goes.
That's great. Thank you for answering that attendee's question. We had another question come in that said, I'm not sure that I heard you correctly, but did you say that setup fees should be amortized over the life of subscription contract?
Right. So I was basically talking about, so setup fee, when you look at setup fee, there are two aspects to setup fee. So what is important to understand when you look at setup fees is to try and see whether the setup fee actually creates a material right or not. Now, what I mean by material right is if the setup fee that you're paid for, right, helps you have a negotiated price, right, for the duration of the contract, then it becomes a material right, in which case it makes sense for you to amortize over the life of the subscription contract. But if the setup fee or the non-refundable upfront fee that you're collecting has no correlation to the contract that you're actually putting in place, then you have every reason to take the revenue on that setup fee in month one itself. So that's how you kind of, so to give you an example, if you were to take a gym subscription, right, there could be an upfront membership fee that you pay for the gym, which entails you, say for a 1-year contract, right, 1-year membership in that particular gym, right, and that 1-year membership has come to you by virtue of you paying that upfront fee. So in which case that upfront fee becomes a material right, and the standard requires you to amortize the setup fee over the duration of the contract. But on the contrary, if that upfront fee has got no correlation to the membership fee or the membership period that you subscribe to, then it makes sense to recognize revenue in month one itself. So that's how it. So the context of setup fee, that's how you look at it. My explanation was more with regard to how you look at free trial period and discounts. But free trial period and discounts also pretty much follows the same theory in terms of writing it off over the subscription contract.
Excellent. Thank you for answering that question there. We had another question that come in, and I think you guys did answer this and address this question during your presentation, but this attendee writes, what do you see as challenges for finance folks in SaaS businesses?
Yes, Jessica. So as you had rightly said, we did cover some aspects as part of the discussion, but just to summarize for our attendees, the challenges which finance folks in SaaS businesses would face is managing the invoices and managing the subscriptions and changes, upgrades and downgrades as part of the life cycle, and how do they reconcile at the end of the day would be a major component of their, the time and effort they spend. So let's take this example, right? So there's a billing system which is managing your subscriptions and invoices. It also speaks to the payment gateway, and payment gateway is taking a fee as part of the processing. The remaining amount is actually then transferred to your bank account. And at the end of the day or at the end of the week, when you're reconciling your payments, the invoices versus the payment received in the bank, there would be a difference in the amount received on books versus the amount received in bank. So that is one of the major challenges which finance folks would face as part of reconciliation. And as part of revenue recognition, as Karthik had mentioned, the ability to calculate the amount to be recognized on a month-on-month basis would be a major challenge based on the way the subscriptions are evolving.
That's great. No, thank you for sharing there. And another question, again, I think I saw a slide on this as well, but maybe it's good to reiterate, just like the last question. This attendee writes, what are the most commonly tracked metrics that you're seeing for subscription companies? I know you mentioned a few, such as ARR and churn rates, LTV. Are there any others that you guys can touch on?
Right. So as I told you, that there were a couple of things that we discussed in terms of standalone metrics and relationship metrics. So under standalone metrics, if you look at it, so you have obviously your MRR, which is your monthly recurring revenue, and you also have what is called CMRR, which is your contracted monthly recurring revenue, in terms of trying to estimate what your likely MRR is. So that's an interesting metric to understand what your futuristic MRR will look like. Right? That's something that most companies try and use to understand how the future spans out in terms of MRR. The other two related metrics in relation to MRR is also to look at what your billing is and what your revenue recognition as per GAAP is. So this comparison between billing, revenue, and MRR is something that's important for finance personnel to understand in terms of how these three numbers correlate each other. Added to that, obviously we talked about lifetime value in terms of dollars, but lifetime value in terms of months is also important to understand, to try and see how long you expect the customer to stay with you and to get a sense of what the customer life cycle is. And that becomes an important component in terms of even how you look at it from a 606 standpoint when you're trying to understand customer lifetime. Because one of the things that 606 mandates is when you look at things like setup fee, you're looking at writing it off or recognizing it ratably over the customer lifetime. So customer lifetime in months will help you, ratably recognize the revenue over the lifetime of the customer. So lifetime value in months is important. The other relevant metric that's also relevant is quick ratio, just to understand, how much vis-a-vis the contraction that's happened. So quick ratio is something that gives you a perspective in terms of how your expenses are adding as compared to your contractions going out. So churn, again, in terms of percentage and in terms of count, is also important to understand. We talked about churn, but churn can be classified in two broad buckets, one in terms of how it works out in terms of number of customers moving out, and also in terms of the dollar value moving out, right? So these are some of the common metrics that typically companies look at from a standalone basis. As regards to relationship metrics, we talked about LTV to CAC, which is lifetime value to cost of acquiring a customer. I think payback period is something which is relevant for companies to look at, which is basically looking at your sales and marketing expenses, the current quarter, and then measuring it against your revenue that will typically come up in the next quarter. Also of relevance from a relationship metric perspective is to look at your bookings as compared to your billings and MRR. Bookings typically is relevant to the sales team. So that's something that typically the sales and marketing team is interested to understand. In any case, I think one thing that we're planning to do as part of this webinar is also to send you some kind of a cheat sheet with relevant metrics and definitions of those metrics, which will give you some context of what these metrics mean. So we talked about a lot of metrics, but then it becomes difficult to absorb it in a span of 50-55 minutes. So which is why we prepared a nice cheat sheet where we have put down and listed all these metrics and given definitions to these metrics so that it makes sense to the audience.
Excellent. No, appreciate you guys answering that question there. We're getting almost to the top of the hour, so I think we have time for maybe just one more question. I know we've seen a lot coming in, so what we'll do is we'll be sure to share all of the attendee questions with ChargeBee so that they can follow up with you after today's webinar. So for our last question, let's take a look at this one here. This attendee writes, what is the proper revenue recognition treatment for a free year discount on a 5-year subscription? Would the free year have revenue recognition, and should the total contract value be evenly recognized over the subscription term?
I think the answer is yes. If the discount that is being given in year one relates to the fact that you've been able to actually sign a 5-year subscription contract, then the revenue recognition needs to happen in the first year as well. Even though in terms of invoicing, nothing much would have happened, but a revenue has to get recognized as unbilled, right? So as per 606 principles. So the answer to that is yes.
Excellent. And I think we can squeeze in one more question since you guys were so on top of that last one. This other attendee writes, how would you contrast SaaS with no hardware but license access?
Okay, I think if we speak about the question from subscription management or revenue operations perspective, I think the product or the prices would be modeled in such a way that the SaaS subscription fee. So let's say somebody is subscribing to Netflix, right, which does not have any hardware related to the service. So if we are on a $10 subscription per month or a $25 subscription per month, per subscription, the charges would be modeled by the merchant, as in Netflix would configure the prices, and it can also have multiple currencies involved. So based on the geography, I think Netflix can charge their customers in different currencies, and the end customers can subscribe to their service and enjoy the services. Netflix, on the other hand, from billing perspective, will manage the recurring invoicing if somebody is upgrading from a $25 plan to a $39 plan or something. So upgrading and proration is something which has to be handled. The licenses behind the scenes would be allocated by Netflix themselves. So the access to the content would be provided by Netflix. So based on the subscription plan you are on, you would be getting the type of content you can subscribe to. So the billing system would then speak with the system inside and ensure that the content is delivered to you based on the plan you are.
Excellent. No, thank you guys so much for answering so many of our attendee questions today. And again, to all of our attendees, any questions that we didn't have time for today, we'll be sure to share with ChargeBee post-event so that they can follow up. Well, we're almost at the top of the hour here, so we want to go ahead and share a few final items. Of course, a big thank you again to Prasanth and Karthik for a great session today. As a reminder, their slides can be found as a PDF under the resource list section of the interface. Please join us at performative.com to continue the conversation with your peers in the community. And if you'd like an introduction to Prasanth, Karthik, or ChargeBee, please do tell us in the survey. Once again, we'd like to thank our partner ChargeBee for making today's webinar possible. A big thank you again to our speakers and to all of our attendees for joining us today. We hope that you all enjoy the rest of your day.